Hello, everyone. Today on the Final Bar, I'm joined by Larry Berman from ETF Capital Management. We'll talk about some of the charts that tell the story of these markets from his perspective. Overall, sort of a choppy day. This is one of those where the S&P moved a lot around the zero level in the end, settles in right around 4,000. It's 0.25% up from yesterday, but growth having a bit of a nice recovery today, up 1.5%. This is after coming off of some fairly beaten down levels. Is this enough to turn the trend? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis, using data visualization techniques, the technical toolkit to better quantify investor behavior, better understand investor psychology, and try to interpret the trends in this market. It's been a choppy experience so far in 2022, netting out to quite a bit of distribution, and this week certainly has shown it's a normal amount of pain up until today. Today was sort of a choppy sideways day, what I would often call a digestion day. You sort of had the big meal, you had the big sell-off. Now this is sort of the after dinner sort of calm moment where you digest what you just ate. The S&P chopping around a good amount. But some nice bounces on some of the growthy areas of the market. Growth are definitely not a word, and some of the defensive stuff pulling back a little bit, like utilities and real estate. The concern I have with that sort of move is it really enough to change these trends that we've seen? I would argue probably not. You're seeing quite a bit of distribution. I don't know if we've seen the "it's all over" sort of patterns. However, markets bottom out in sort of a period of disbelief, sort of that initial move higher. No one really thinks it's most likely the bottom until later when it becomes more and more clear that that was the case. We'll see what some of the evidence can tell us about these current market conditions. We have great guests on the show. I'm excited to talk to Larry Berman here in a few moments. Tomorrow on Wednesday, the 11th, we have John Gagliardi from Fidelity Investments. On Thursday, the 12th, Matt Maley from Miller Tabak and founder of the Maley Report coming to us from Boston. So a couple of really good, thoughtful strategists sharing some techniques with us through the course of this week. Ari Wald, by the way, will be with us beginning of next week as well. Let's continue on today's show with our market recap. Let's break down the action in the market, see what's happened, and try to connect today's action with the longer-term trends, which I hope is part of your goal using the StockCharts platform. The S&P, as I mentioned, settling in right around 4,000. We're going to look at a chart of Bitcoin a little later in today's show, and you'll see how big round numbers often have meaning, more meaning than you might expect on a lot of different charts. We'll talk about it in terms of Bitcoin and Ethereum, but the S&P settling in right to that big round number, just above 4,000. The NASDAQ composite up about 1%, NASDAQ 100 up 1.3%, while the Dow was down about 0.25%. So you can see the sort of growth over value type of thing, assuming the NASDAQ is a good proxy for growth. And the Dow, obviously a lot more value-oriented, sort of traditional blue chip industrial types of names, although a lot of others represented in the index as well. But overall, that was the move of the day. The VIX coming off a little bit down to 33, still well above that 33 level, which we've talked about as being a key level to focus on. Interest rates overall coming off, so 10-year yields back below 3%, 30-year yields, the long bond yield still above 3.1%, and the short end of the curve actually popping up a little bit. So you get a bit of a flattening as long bond prices, the TLT was up almost 1%. The dollar index continuing to push higher. As we get to the commodities, you can see how gold is coming off. And again, with a raging dollar continuing to push to the upside, it's hard for precious metals to mount any sort of serious gains to the upside when that is the environment that we're in. So you see gold down about 1% using the GLD, silver down over 2%, and energy prices for the most part down as well. Cryptocurrencies, a lot of green today. Now, this is after some serious red showing up on the monitors yesterday. And what's really interesting at this chart, by the way, we talked about big round numbers. Look at how Bitcoin literally hit 30,000 and turns on a dime and rotates back higher. We'll look a little later at a chart of Bitcoin with some of those key big round numbers, 30,000, 20,000, 40,000, 60,000. Every one of those levels that I just mentioned has been a small or large turning point in the price of Bitcoin over the last year or so. We'll look at the chart together. You can see how that's played out. It's always important to pay attention to those levels because it's sort of a psychological thing, I think, more than ever, right? When the price hits a big round number, when we think about whether or not Bitcoin deserves to be below 30,000 or not, that's when buyers tend to materialize and push the price back up. Bitcoin up about 4%, with Ether up over 5% as we're recording the show here after the equity market close. Let's go to a daily chart of the S&P 500. As I mentioned, the S&P closing right around 4,000. Now, this is up a little bit from yesterday's close, although we did undercut yesterday's low on an intraday basis. Right where we're at, around 4,000, which is where we close today, represents about a 50% retracement from the September 20 low to the January 2022 high. So that's that high there, and then the low that's off the viewable area here from the third quarter of 2020. You take that entire range to the upside, 38.2% of the way down was right around 4,200. That's why we've talked about that level many times so far this year. We've broken that. We even broke 4,100, which got us below the low from February. And now we're right in a rounding error, within a rounding error of that 50% retracement level. What happens if we break that 4,000 level and go and get a confirmed follow through below that level? That would take us down to the 61.8% level, which also represents a 38.2% retracement of March 2020 to January 22. That would get us down to around 3,800. I'll back the chart up a little bit more so you can see what I'm talking about, right? So if you take the low from September 2020, you take the high in January of 2022, we have 38.2% of the way at 4,200. 61.8% of the way is just above 3,800, so like 3,815 or so. That also represents 38.2% of the way down from the high in January to the low back here off the viewable screen in March of 2020. So that's a pretty significant level. Now, that is a fairly consensus level. I've heard a lot of people refer to that because when you look at Fibonacci retracements, so many techniques are sort of lining up right around that same time. So it's a fairly logical downside target for the S&P. And what's also interesting is if you think of this as a big sort of head and shoulders type pattern with a high surrounded by some lower highs, you break the neckline, which you're arguably doing this week. You take the height of that pattern and subtract that from the lows, that gets you just below 3,800. So even the height of this topping pattern kind of lines up with that downside objective as well. So it's a reasonable downside projection. My concern would be what happens if we fail to hold that level. Then what? Then you're looking at some really beaten down downside objectives. But first things first, I think keep your eye on this 50% level where we're at this week. Does this week resolve back to the upside? Do you get buyers coming in to push prices higher? Or do we get the opposite? We'll know here as the course of this week plays out. Looking at sectors here very briefly, we had technology by far the biggest gainer, up 1.5%. Energy recovering nicely from yesterday's distribution. A lot of energy names pulled back pretty significantly yesterday. The XLE up 0.9%. Communication services was the third strongest sector today. It's about half and half in terms of up and down for the day. At the bottom of the list, we have real estate, we have utilities, we have financials, and the consumer staples. So it's some of the defensive areas in the market, things like utilities and consumer staples. Financials is usually sort of a play on interest rates, play on the yield curve, and you can see that the XLF is coming off as well. Let's finish off here looking briefly at the Mindful Investor Live chart list. This is a list of charts that I keep updated on StockCharts.com, and I just want to do it to highlight some of the breadth conditions here just to see where we're at. Now, I update these colors on Friday, usually before the show on Friday, just looking at breadth conditions. So here we're looking at the S&P 500 on a closing basis. And again, the most damning evidence I would say for the S&P is its inability to hold support. We've now clearly undercut the March lows. This is a chart in any definition in a downtrend, lower highs, lower lows, and we're seeing that pattern continue as May proceeds. Now, these other four data series are the cumulative advanced decline lines for the New York Stock Exchange, for large caps, for mid caps, and for small caps. As of yesterday's drop, the mid cap advanced decline line has now made a new low for 2022. Now, already before yesterday, we had a new low from we'd undercut the March lows for small caps and also for the broader New York Stock Exchange. The only one that has not yet done so, not yet broken its low for March is the S&P Advanced Decline Line. This is a measure of large cap market breadth, and that's pretty classic for a market top. The smaller, sort of higher beta, more speculative names tend to rotate lower. You get the large mega cap names that tend to lag behind on the way down, but that breaking below that support level for March could be an interesting indication of further deterioration. This next one I wanted to point out because as of yesterday's close, this isn't updated for today's close just yet, but as of yesterday's close, about 31.5% members of the S&P 500 index are below their 200-day moving average. So less than 1 in 3 are remaining above their 200-day here. Only 21% of the S&P remaining above their 50-day. That's a new low for this year and actually a new low for multiple years. We're really getting a beaten down reading from that indication. The reason why I had these purple lines on here is because for the last 6 to 8 months, this market's been pretty easy. And I say that with a great dose of sarcasm because it's been challenging at times, but look at when the indicator gets up to 70%. That's 70% of the S&P above their 50-day. That tends to be a sort of sellable peak in the market. You get the indicator below 30%. Those tended to be the buyable dips. And you can see overall that matches pretty well the peaks and valleys in the price. That may be changing here because we had a little drift below the 30% level. We bounced back up, which should suggest that that's a nice buyable dip. If that pattern continues, the pattern appears to be broken as this indicator makes a new low down around 20%. Again, when you're looking at a market distribution, it's all about bombed out sentiment, bombed out breadth. Charts like this tell me that at some point, we're certainly going to reach a low. I don't know if I've seen enough to tell me that low has happened today. Let's take a quick commercial break. We'll be back with today's guest, Larry Berman. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. We're going to welcome on today's guest, Larry Berman, here in a few moments. Before we get there, first off, we welcome your questions. Our email address is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions, and we'd hope to answer one of yours in our next mailbag segment, Friday of this week. Also go to StockChartsTV.com. That is our free on-demand platform. Knowledgeable expert guests and commentary. People like Larry Berman and Ari Wald and Katie Stockton and many others. Special events and interviews like The Pitch, Larry Williams' special market outlook from a couple weeks ago. All available on our on-demand platform at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Larry Berman. Larry is a chief investment officer, the founder of ETF Capital Management, coming to us from Toronto. Larry, I've known for a number of years, and I think his perspective is well worth paying attention to in any market, but particularly this one. Larry, it's good to see you, and welcome back to the show.
Well, thanks, Dave. It's always exciting to, let's say, butt heads with you is not the right way to say it, but to
collaborate in a respectful way. I think that's what you mean.
In a respectful way and discuss the charts and what the pictures are telling us.
So we're entering sort of that seasonal pattern where people start talking about sell in May and go away, and you're starting us to sort of your seasonal take on this year. Can you talk us through this chart, what it tells us about where we're at?
Yeah, so in our Pro Eyes series of indicators, and going back 25 years when I first did my CMT paper, it was around a indicator I developed that was very similar to this. And it combined a bunch of technical indicators. And today I wanted to focus on the seasonal aspect of things because, as you correctly point out, it's quite timely. So what we're seeing on the top blue line here is the 1 month forward return of the S&P 500 in the second year only of a presidential cycle. So you could take all years together, and those seasonals are generally pretty bad, that sell in May and go away. But in the second year of a presidential cycle, they're exceptionally bad. And this year, obviously, we've seen a pretty nasty start to the year. One would argue, though, from that perspective, because normally you get a pretty decent first couple months, that maybe the seasonals won't be as dominating through the summer months. So that's something to think about. And so on the bottom here, statistical, because I'm all about the zeros and ones and probabilities. We take the historical patterns, again, going back to 1926 in this case, in terms of the daily data, and then we put it into a z-score. So the higher, the more negative the z-score in this case, the worse your forward-based returns are, and then the more positive it is, the more opportunity there is in terms of forward-based returns. So, seasonality has, in our 12-factor model, is two components. We look at all years together, and then we emphasize the current year. But a lot of the things you talked about today, Dave, in terms of market breadth, we have 3 market breadth indicators. You didn't cover some of the sentiment indicators, but we look at sentiment as well. So Berman's called ProEyes. If you Google that, you'll find it. We've been publishing it for a couple of years now. If you know the fear and greed index from CNN, this is way better. It takes some of those components. It actually adds in some valuation metrics, some business cycle metrics, and these 12 technical factors, of one of which we're looking at right now.
So your second chart, Larry, is talking about this tactical risk monitor and looking at that relative to, we have the S&P on the top, and then we're showing that overall here. Can you talk us through what it's telling us about the conditions today?
Yeah, again, it's a probability-based model. So when the statistics kind of say that all our 12 factors together, red, sentiment, seasonality, overbought, oversold, all the indicators that a technical guy would tend to look at, no Elliott wave in here, but the more macro ones, weight them all together equally, and then say where. So what it's telling us now is we got a bit of a divergence. Now, you highlighted the lower lows that we're seeing in price now, but my macro indicator here is giving us a bit of a divergence. And that's kind of interesting for me. Usually these set up as good trading opportunities. I wholeheartedly agree with you. We're probably in a bear market. We're probably not done. And that 3,800, somewhere in there seems not only logical from a technical standpoint. We can put some numbers on that. In fact, David Costin from Goldman Sachs this week said in recessionary scenario, 3,600. But in the same breath, he said, well, if there's no recession, it's 4,700. That's kind of like the alternate count, I guess, for a strategist. But right now we're set up for an oversold rally. So maybe it's buy in May and make some hay, as opposed to what we're used to here, but for a bounce. So I'm calling, 43, 4,400 before we see the 36, 3,800, but we're most certainly going to see that, over the next few quarters on the downside.
So when you're looking at this market, we only have about a minute left there, but when you're looking at this current market and you see this this overall sort of choppy period right around 4,000, where would you look for opportunities now? You have areas of market like energy, which have obviously had a really good run and now showing some short-term pain, but a lot of people looking at the larger growth stocks and seeing that they're pretty far off of the highs. Where do you look opportunistically here?
I'm a CFA as well. I put the fundamental hat on. You look at the consumer staples and you look at some of those safe companies. They're trading at 24, 25 times earnings. You look at the Apples, the Microsofts, the Googles that have taken a lot of the pain in the NASDAQ, coming down from the highs, and they're trading at the same multiples. What would you rather own, a growth stock at a 25 times or a consumer staple at a 25 times? Just pointing out something, obvious there, but maybe not. If you're just looking at the charts, maybe you don't have that lens. And that's why I like both the CFA and the CMT. Get the CFA to help you get the job, get the CMT to help you keep the job.
I like that hybrid approach, that fusion approach of combining the two in a meaningful way. Larry, you do it as well as anyone. Larry Berman from ETF Capital Management. Great to see you. Thanks again for coming on, and stay safe up there. All right.
You too, Dave.
That's Larry Berman. Larry's the CIO and the founder of ETF Capital Management, coming to us from Toronto. One of the most well-known Canadian technical analysts, if not the best-known Canadian technician. And I've been able to serve on a board with Larry, which overall was a very positive experience. And I've enjoyed following Larry and his work for some time there. I like that thinking though. So it's an interesting, as I've shared on the show before, as an institutional investor, we would think a lot about comparing stock A versus stock B. It was never just whether or not this particular name seems like a good idea. It's, should I pull this lever or this lever over here? And that's an interesting question. Think about valuations, looking at a staples name versus a growth name that's come down to a decent valuation. I get the argument. It's definitely making me think a little bit. Great take there from Larry Berman. Let's continue on today's show with the final bar mailbag. As a reminder, we are here to help you make sense of these markets the best we can. Our email is thefinalbar@stockcharts.com, and keep your great questions coming. Here's question number one. I know you're a big fan of monitoring breadth and not so much a fan of volume. So does that mean that advancing and declining volume on the exchanges aren't as important to follow? Really good question. I definitely do not mean to skew everyone's perspective on breadth or sentiment or anything based on my own preferences. But I truly believe that as a technical analyst over your career, your edge, if you have one, is basically to define your toolkit. Here is my approach. Here is the way I look at things. And this is the lens with which I'm trying to make sense of the world around you. And so for me, it's focusing on price action, then breadth, then sentiment. It's focusing on investor behavior and what's in your control as an investor, thinking about your routines, what information you consume, and how you develop a trading strategy. Now, there are others that do completely different things and have completely different inputs, and that's what makes it a fascinating market. But I've always said that's why there's always someone to buy when you need to sell, and vice versa. So having said that, I do look at volume, and one of the technical analysts who I definitely consider a mentor and a good friend, Walter Deemer, who ran the technical research department at Putnam Investments in the 1970s. He's a big fan of using advanced decline volume. Mark Chaikin, who I respect a great deal, and I also consider a mentor, has done probably more than anyone at refining the use of volume, looking at things like accumulation distribution and upgrading what I think just pure volume analysis, and even Granville's on balance volume. There are better ways to do it. I think Mark Chaikin with those indicators and the Chaikin money flow do a great job of sort of improving that. So one of the charts I do look at in my breadth chart list is this one, which is looking at advancing volume on the New York Stock Exchange. It's looking at up volume minus down volume, and then it's showing the two of them separately at the bottom. And I look at that after the close every day just to sort of make sense of the overall volume characteristics. But my basic general what's happening with the day, I just look at price changes and I keep it super simple. And it's how many stocks went up on the day, how many stocks went down on the day. My toolkit is by necessity, fairly simplistic, because I've spent most of my career working with money managers and investors who were not technically oriented. So I had to help them understand what we did as technical analysts, as market behaviorists, and how that related to their toolkit of valuation and earnings growth and all of that. And so I tend to err on the side of simplicity, because I found that ends up being more repeatable and more consistent, but also more straightforward and easier to wrap your head around. So advancing declining volume absolutely could be an interesting part of it. I'm a big fan of Mark Chaikin's indicators like accumulation distribution and the Chaikin money flow for sure. Next question. What should be the conceptual order of performance / relative performance to look for in the indexes in the start of a bullish market? OEX, SPX, NDX, IWM, you had a number of different things on there. So basically, if the market does bottom, where do you tend to see the leadership from first? Is how I would paraphrase your question. And of course, the short answer is it depends, right? I mean, I would love to tell you, and at times we went through and went through sort of the market top checklist and the market bottom checklist, right? What are the things, and all we need to do is look for these 5 things and just follow along with the little report card and check them off. And yep, it'll be obvious. I will tell you, having gone through that exercise many times, there are general consistent themes to things. However, every time is literally a little bit different, because the conditions we're seeing right now in terms of the Fed and the activities that they're doing, inflation, which is a sort of a new phenomenon that we haven't had to deal with in a long time, just this particular combination of things. I would say in some ways we're sort of in our own set of observations. I don't know if there's a particular playbook that I would say is readily available for this, but generally speaking, there is a trend to things, right? And if you think about it, the OEX, probably out of all the things you said, represents sort of the very traditional large cap defensive equity area of the market. Now it does have some, it's obviously some offense in there, but it's going to be much more geared to the defense than something like the NDX, which is going to be technology, communication services names, more growth-oriented names. I think the reason why this might be different is because we are in very much a different environment where growth is not just ripping to the upside. You have value areas of the market outperforming. So out of all those things I said, I think looking at the Russell 2000 could be very interesting because people tend to own smaller names like that when they want to speculate and they want to take an aggressive bet. They want to add risk. If you're selling small cap stocks, it's because you're taking risk off the table. If you're putting money down there, that means you're trying to find great ideas that you can get to pop up. So I would be looking at the Russell 2000 leading on the downside, which it has been doing. I would be looking for some stability there. And the short answer is we're not seeing it yet. Next question, what person, entity, group decides when to take the plunge and start buying to turn the market? I mean, like in a former industry of mine or in the political parties of the day, is there some internal memo? I love this question that gets passed around the street that today is the day to buy. It's such a fabulous question. And just in a few moments while we have. So no, the short answer is no, there is no memo. However, what you have to remember is that big institutions managing large amount of capital, everyone is talking to one another. Now, a long time ago, I'm talking decades ago, you go back, pre 2000 and well before that, we're talking like the movie Wall Street sort of environment, Charlie Sheen type of thing. That is when there was the ability to have, to be able to talking and the edge you had was that you were able to communicate and no one else was. You had information that no one else had access to. And so it was all about access to information. It was all about being able to see, talk to companies when individual investors would not be able to. All of that's essentially gone, right? You have access to plenty of great information. What you're able to do on StockCharts used to require a team of people with big paper charts at a big money management firm. So it's just not the case. It's not the case anymore. However, a lot of big institutions, the trading desk in particular, are talking nonstop, and they're trying to get a sense of where things are headed. We would often talk to our trading desk and just get a read on what they were hearing from other shops, and it would give us a sense of things. At the end of the day, though, it's more about being able to take on risk and able to put money to work when the market's down and take money off when the market's working. That's something individuals tend to avoid wanting to do, and institutions are able to do that because they have the economies of scale. They have the ability to do so and throw money at ideas when they might need. I might have a deeper answer to that question, but that's all I can give you in this short amount of time. We need to wrap the show, folks. Go to the 3 and 3. Let's go through 3 charts in 3 minutes that tell the story of this market. Chart number 1 is Adobe Systems. We were looking at the S&P today, talking about this choppy market, but the Nasdaq up a little bit. Large cap growth, one of the better places to be just today. Chart like Adobe is one of the biggest gainers in the S&P 500, up over 4% today. So on the surface, bright green, up 4%, not too bad. Maybe I should take a look. But here's the problem I have with the chart like Adobe from a technical perspective. This is nothing other than a downtrend at this point. The bounce is interesting. And what that does is it establishes yesterday's close as probably a new swing low. But if you look at the patterns of those lows that are kind of sticking out with higher lows around them and the highs sort of sticking out with lower highs around them, you can see that this trend overall has been down. A chart like Adobe starts to improve when you stop making lower lows and start making higher lows. That is when you have evidence that investors are coming in and buying on weakness. We're not seeing that yet on some of those names that are bouncing today. This is still, I think, more of a mean reversion bouncing off of short-term weakness for now. Chart number 2 is looking at gold. We're using the GLD here. Talk about a choppy sideways environment over the last 2 years, coming off again today. And I think this is in many ways about the dollar. Dollar is strengthening. The dollar continues to make new highs, continues to be in a strong uptrend. I would not anticipate gold mounting any sort of great uptrend while the dollar remains in a strong uptrend. If you're worried or if you're concerned about the chart of the GLD, I'll be looking at $ USD or the UUP ETF to see when we get some sort of change in that uptrend. Finally, here is the chart of Bitcoin with purple lines identifying those big round numbers, 60K, 50K, 40K, 30K, 20K. Just look at how often the price has bounced around those levels. This is why we've been talking about 30,000. This is why I would argue it's served as support so far this week. Folks, that's our show for today. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to Larry Berman from ETF Capital Management, joining us from Toronto. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.